So the session 5 we are starting today, and basically throughout the session we are going to discuss about the roles and functions of modern central banking. If you can recall our very beginning few sessions, very introductory sessions, we discuss briefly some of the historical functions and roles of modern central banking. The historical central banking. But today we are going to in detail discuss on the roles and functions of modern central banking. So through that we will create all these sub topics coming under the roles and functions of modern central banking. Now, when we talk about the role or the functions of the modern central banks, their key role is to provide a sound and stable macroeconomic environment. So we say it should be a sound and stable macroeconomic environment. So it says that if we have this sound and stable macroeconomic environment, it will ensure the long-term sustainable growth of the economy. So to achieve this long-term sustainable economic growth, we should be having a sound and stable macroeconomic environment. So when we have this stable and sound macroeconomic environment, all these decisions can be consumption decisions, can be investment decisions, all these decisions by the households or the firms, basically by the private sector, can be optimized, because when the system or when the macroeconomy is stable or sound and stable, means there is no vulnerable situations, there is no shocks, there is no variation, it is static. So when there is a static situation in the system or the economy, we know the certainty is there, so the people will have the confidence on the system. So therefore, we say having a sound and stable macroeconomic environment is crucial to have optimal consumption and investment decisions. How this central bank achieve this sound and stable macroeconomic conditions? Basically through maintaining monetary stability and financial stability. So basically through maintaining monetary stability and financial stability. So what is this monetary stability? Simply we say monetary stability is all about safeguarding the value of the currency, and the financial stability is about helping the financial system to function smoothly and efficiently. So this in Sri Lanka, our central bank also have two primary objectives, which is economic and price stability and financial stability. So here, same as the modern central banking objectives, right? So we do have price stability. So yes, there is a small difference between monetary stability and price stability. Under the price stability, we consider much more about the domestic context, domestic currency, domestic price levels. But when it comes to the monetary stability, it is quite a larger, wider scope it has. Monetary stability, it can be domestic and foreign both. So anyway, it's about safeguarding the value of the currency. So the financial stability means ensure that the financial system functions smoothly and efficiently. So all this having a sound and stable macroeconomic environment is crucial for a long-term sustainable growth. So to achieve this long-term sustainable growth, we will or the central bank will maintain monetary stability and financial stability. So these are the roles of the central bank. So to fulfill these roles, central bank use several functions. There are many functions. Among all these functions, these are the key functions. We can narrow down these key functions as the functions of modern central banking. So we have issuance of money, conduct of monetary policy, payment system facilitation, lender of last resort, and the banking supervision. So some of these functions were there under the historical functions as well. So these key functions are the typical central bank might have these key functions. For a typical central bank, so maybe from economy to economy, country to country, based on whether it is a developing country or developed country. Likewise, and according to central bank practices, these functions can be varied. But we can identify these 5 functions as the key functions of modern central bank. So now we are going to discuss these functions one by one. So here, as I said before, the roles of the central bank is to maintain the monetary stability and the financial stability. So this monetary stability will be achieved through these basically from these 2 functions, which are the money issuance and the regulation of the money condition. And the financial stability will be achieved through payment system supervision and oversight, lender of last resort, and the banking supervision functions. So the functions we can categorize under the 2 roles, monetary stability and the financial stability. Now starting with the first function, which is the issuance of money. So this when we talk about this money issuance, so normally central bank issue these bank notes, and if you observe a bank note, we can see the counter signatures on the bank note. So from whom we do have these counter signatures? In Sri Lanka, we have 2 signatures on the bank note, one from the Minister of Finance and the other one from the Governor of the Central Bank. So what do these counter signatures on the bank note represent? So it implies that these bank notes have the backing of the sovereign. That's why, so that in simply that means, in other words, central bank is reliable, or central bank is liable. Sorry, central bank is liable on the money issued by them, right? So this money can be issued in the form of banknote and also in the form of electronic. So the electronic form of money is also there. So how do we issue this electronic money? So basically through credit in the commercial bank account held at the central bank. Central bank will credit the electronic money or credit the amount with the account held by the commercial bank in the central bank. So how can they just credit the amount? No, there should be a transaction. Normally, if they want to inject the money into the system, they will purchase the government securities from that particular commercial bank. So when they purchase or when they buy the government bonds or the government securities from the commercial bank, so the money will be, so they will pay the money for the bank. That money will be electronically credited to that particular account of the commercial bank. So that's how the central bank issue money electronically. So we say this money goes through a process called money creation process. So what is this money creation process? So we say this the money creation process multiplies the initial amount of money issued by the central bank. So, if we compare the final amount of money which is circulated in the economy and the initial amount issued by the central bank, we can observe that the amount has been multiplied. So this multiplication happened because of this money creation process. So let's discuss this money creation process using an example. So this is the example 1, and we will discuss this example step by step. So using several steps, we will discuss how the money is created. So let's assume that initially central bank print new bank note and issue them into the system, which is worth of $100. So the central bank issue money $100. So this newly issued money is a liability for a central bank. Why money is a liability for a central bank? Because it's a claim on the central bank. Central bank is liable for that issued money. In case if this money has a problem, central bank is the party who is liable because they issued the money. So this newly issued money is a liability of a central bank. So that's why we show here the $100 in the liability side of the balance sheet of central bank. Now central bank have this $100 with them, newly issued money. So normally when central bank want to inject this newly issued money to the system, they will engage in purchasing new assets. These assets can be government bonds, can be gold or foreign securities or foreign currencies, treasury bills, treasury bonds, can be anything. So basically central bank will purchase new assets in order to inject these new banknotes into the system. Let's suppose now the central bank selects this commercial bank A for the transaction. So central bank select the commercial bank A. So to issue the money to give the money to commercial bank A, central bank will purchase government bonds from the commercial bank. So when that transaction happened, when the central bank purchased the government bond from the commercial bank A, central bank will receive government bonds worth of $100. So now the central bank has a debit in the asset side worth of $100 in terms of government bonds. So when the government bonds are purchased by the central bank, that asset which was there in the balance sheet of the bank A should be credited. That asset should be credited. So the government bonds account should be decreased or credited by $100. But when they sell this government bond to the central bank, they received the bank notes on the other hand. So the bank notes are now with the commercial bank A. So the bank note is an asset. It will increase the asset $100. Now this double entry system facilitates this transaction by injecting the money into the commercial bank A by purchasing the government bonds by the central bank. So now the central bank has the $100 worth of government bonds asset. Instead, the bank A has $100 worth of bank notes. So that's the transaction 1 or the step 1. Now we are coming to the step 2. In the step 2, let's assume that now the commercial bank have the $100 bank note. So this bank notes or the currency, they do have a opportunity cost. We know the money has an opportunity cost. So will the bank keep the money idle in their wallets? No, right? So it's a cost for the bank keeping money idle with them. Instead, the bank will decide to grant a loan. So they will lend this bank note to people. So for this example, let's assume that this loan was issued to a firm called X. Now the X is borrowing money from the commercial bank A. Now what happened in the balance sheets of the commercial bank A, their bank notes, the asset which had with them before will decrease by $100, and on the other hand they will have a new asset which is a debtor for the loan issued for the firm X. So they have $100 worth of asset with them, which is the debtors of the commercial bank A. Now this money, $100 is with the firm X, right? Now let's say this firm X will use this money to pay its supplier, which is who is the individual one. So let's suppose this particular person one receives this $100 as a payment from the firm X. So the firm X utilize the money for their transactions, and now ultimately the money is with the individual one, right? So that is the step 2. Now, in the step 3, what happened? This individual one who received this $100 worth of bank notes, he decided to deposit that money in the bank. A new bank now comes to the story, which is Commercial Bank B. Now, the individual one who received this newly issued money, $100, he has no urgent use of this money, so he decided to invest the money, because holding cash in the hand is there is an opportunity cost. So to avoid from this opportunity cost, to earn an interest, he decided to deposit that $100 received in a bank called Bank B. Now the new bank comes to the story, Commercial Bank B. So when this individual one goes to the bank and deposit the money, that deposit is a liability for the Commercial Bank B. Why? Because the bank is liable to pay back the deposit whenever the individual one asks it. So that's why we record it in the liability side. So the liability of the Commercial Bank B will increase by $100, right? So up to now, what happened? If we summarize the steps so far happened, the first one, what happened? The central bank issued $100 into the system to inject into the system. It purchased the government bonds from the Commercial Bank A. Then Commercial Bank A has the $100 bank notes. So then the Commercial Bank A decides to lend that $100 in order to earn an interest. So they lend that $100 to X. So X pay that money because individual one is a supplier of X. So X pay the $100 to individual one. So individual one do not have any urgent use of this $100. Therefore, he decides to deposit that in the Commercial Bank B, new bank. So now Commercial Bank B has $100 worth of deposit, which is a liability for them. Then the Commercial Bank B, they will decide. So the Commercial Bank B having a deposit means they have the money with them now. Again, it has opportunity cost. For the deposit, they have to pay interest rate for individual one. They have to pay interest. So to earn that expenditure, they should earn a revenue using the deposit. For that, they will lend that $100 to someone else. Let's suppose to individual 2. So the Commercial Bank B loans out $100 worth of bank notes to individual 2, right? So now you can see that we have a deposit here worth of $100 and cash we have $100 with individual 2. Now tell me how much is the money supplying the economy. Normally the money supplying the economy is considered as a summation or as a addition of the currency held by the general public and the deposits of the general public held in the commercial banks. There are many definitions. There are different types of money like M1, M2, M2B, M4. Later we will discuss those. So for this clarification, for this example, let's assume that the money in the economy is the narrow money base. So this narrow money equals to the currency held by the general public plus the deposits held by the general public in the commercial banks. So now how much is the money then? Initially it's $100, which is issued by the central bank, which is later get by the firm X and later transferred to individual one. Then this $100 was created as a deposit in the another commercial bank B. So now if you are considering the money as the summation of demand deposit plus the currency held by the public, then we have $100 worth of deposit here, which is the deposit by the individual one, and also the currency held by the general public, which is individual two, again $100. Now in this step, when we come to the step 3, now the total money which is circulating in the economy is $200. So the amount of money in the system has doubled to $200. How? The $100 deposit here and the $100 banknotes with this individual too. Now the money increases up to $200, right? So the money creation, it multiplies the money. Then the last step, step 4. So in step 4, what happened? This individual too, who got the money, $100, he decided to purchase some of the materials from a merchant. So that money goes to the merchant 1. Let's assume that this merchant decides to deposit that money in another bank, commercial bank C. So the C will again get a deposit worth of $100 by merchant 1. Then this $100 will again lended by the C to earn an income, right? Let's suppose that individual 3 received this loan, then $100 is with this individual 3. Now how much is the money in the system? Now we do have $100 worth of deposit made by the individual 1 at the commercial bank B, and also here another deposit has been made by the merchant 1 in the commercial bank C, again $100. Then this individual 3 ultimately received the $100 banknotes. So altogether there were $300, right? So we started with $100 issued newly into the system, but let's suppose that individual 3 decided to keep the money and decided to not to deposit somewhere else. Then total $100 newly issued by the central bank multiplied until it becomes $300. So that simply means the money creation process, right? So the money creation process means the final amount of money that comes out of the money creation process constitute the money supply. So this money creation process multiplies the initial amount of money issued by the central bank. In our example, we started with $100 and ended up with $300, right? So that is the money creation. So this process is likely to continue since individuals or firm will keep cash on hand only up to certain level. Why? Normally, we do not keep all our money in our hand. We will invest somewhere, right? Deposit it somewhere. So unless the people decide to keep the money 100% with hand, this process will continue up to that, right? So this process is likely to continue until the people decide to hand only up to a certain level of cash with hand, and this extra cash beyond this level will be deposited somewhere. So these deposits will increase the money, right? So that is the money creation process. So this amount of money created will be limited. Why? Because the banks need to keep some cash with them, maybe cash on hand or cash on their wallets or in the central bank deposits account. So these commercial banks need to keep some amount. So in our example, for the simplicity, we consider all the deposit received by the commercial bank will be lended out. But in practice, it cannot be done because there should be some amount of cash available for the day-to-day operation of the commercial bank, as well as to meet the regulatory obligations by the central bank. So we call it, these are reserve requirement of commercial banks. So this reserve requirement, and also the second reason why this amount of money created will be limited. The first reason is the reserve requirement. Second reason is the number of borrowers where lending is limited. Why? In our example, we assume that all the deposit will be lended out from all the banks, right? Bank B and Bank C. But in practice, can the commercial banks lend all their money? No. Can they find suitable borrowers always? No, right? So this number of borrowers who are worthy for lending will be limited. So these reasons will be caused to limit this amount of money that will be created through this process. I think you are clear what this money creation process means. And here we have to learn about this deposit expansionary multiplier, or in other words, fractional reserve bank. So previously I explained there is a reserve requirement for the commercial banks. So this reserve requirement specify the rate of reserves from the deposits that they have to retain with them, or the ratio of the reserves to deposits that the banks are legally required to maintain. Out of their deposit, this much of ratio of reserve should be maintained with them without lending out. So this reserve requirement, we call it fractional reserve banking, because among the deposit, a fraction will be kept as a reserve. So that is the fractional reserve banking. So this deposit expansionary multiplier can be taken through 1 divided by this reserve ratio. For an example, let's suppose that the commercial bank need to keep 5% from the deposits with them as the reserve. So let's suppose this initial base money is $100. So this, from the $100, 5% they have to keep as the reserve. So that is the fractional reserve banking. So if we want to calculate how much will the money, how much amount of money will be created using this $100 initial amount, we can calculate the deposit expansionary multiplier. It is equal to 1 divided by the reserve ratio. So here our reserve requirement ratio is 5%. That means 0.05. So when we divide 1 by 0.05, we get the answer 20 times. So that means, so this initial $100 into 20 equals $2,000. So this 20 is called the money multiplier. So that means money multiplier equals to 1 divided by reserve ratio. So we can say our initial amount of $100 will be increased from 20 times, will be multiplied by 20 times and created this money up to $2,000. So that is the deposit expansionary multiplier. Now you have given this example too to do by yourself. So the assumptions have been given. The first assumption is only 10% of notes and coins from income is held by people for transaction, and rest of the income is deposited in bank accounts. Simply that means if you receive 1000 rupees, you will keep only 10% from the 1000, which is 100, and the remaining 900 you will deposit, right? Then the second assumption is bank keep 2% of total deposit liabilities as notes and coins to pay for customers at their request. So bank also, out of their total deposit, they will keep 2% as the notes and coins for their day-to-day operation. Third assumption is the statutory rate of reserve is 10%. That means in addition to the 2% of cash which will be held by themselves, additionally 10% out of the total deposits they have to retain as the statutory reserves by the central bank. Now the person is initially provided with rupees 10,000. So you are asked to do the calculation, do the money creation process and calculate the total money at the end of all these rounds. For the simplicity, let's say there are only two banks, commercial bank A and B. So initially the person who received the $10,000, 10,000 rupees will deposit that money with the bank A. Then ultimately that deposit as the lended money will come to the bank B as a deposit again. So up to that point, calculate the uh, accounts, what will happen to the money creation process. So you have to follow this assumption. In our first example, we do not have these assumptions. It was a very simple example. There we only discuss very simply how the money will be created. But in practically, all the commercial banks will not lend all the 100% of their deposits. They will retain cash with them, and the statutory reserves likewise a certain portion will be only lended out, right? So now you have to do the calculation like we did in the example 1. You have to do the same for the example 2. I suppose you might calculate the steps. Let's say, check your answers, whether your answers are correct, or if you have any doubts, you can raise it now, right? Let's compare the answers. This is step 1. So initially we received the money, rupees 10,000. So under the assumption they say, currency held by the general public is 10% from the total amount of money, right? Only 10% of notes and coins from the income is held by people for transaction. So when this person has 10,000, they will keep 10%, which is 1,000, as the cash or currency held by the public, and the remaining 9,000 comes to here as the deposits for the bank A. So the remaining 9,000 will be deposited in the bank A. So then again there are two other assumptions. Out of the total deposits, 2% is the cash held by the bank and 10% is the statutory reserves of the central bank. So the 9,000 into 2% means 180. That is the cash held by the commercial banks. And from the 9,000, 10% is 900. That is the statutory reserves. So altogether remaining deposit is 7,920 for the bank A. So this remaining deposit will be lent out by the bank A as loan. So that is the step 1. So we received 10,000. Out of 10,000, public will keep 1,000 as cash and the remaining 9,000 will be deposited. From the deposits, 2% and 10% will be kept as cash and statutory reserves, the remaining 7,920 will be loaned out. Right? So this is the step 1. I suppose you are clear. If you have any doubt, you can raise it now. Now we are going to talk about this loan issued by the Bank A, 7,920. In the step 2, let's say if the person who borrowed the money from the Bank A has spent it for different purposes, and at the end the person who received the money deposited it in the Bank B. Now the 7,920 worth of money is there with the public. So out of that money, again 10% will be kept as currency held by the general public, which is equal to 792. The remaining part will be deposited in another bank, Bank B. So the deposit is equal to 7,128. That means 7,920 minus the currency held by the general public. That is the remaining part which will be deposited in the Bank B, equal to 7,128. From the total deposits of the Bank B also has to maintain 2% of cash and 10% of statutory reserves. So 2% equals to 142.56. 10% means 712.8. So the remaining part, 6,272.64, will be loaned out by the Bank B. So that is the step 2. I asked you to calculate up to 2 steps. So that's all. Right? So I suppose now you are clear how to calculate such a question, right? So we have to always accommodate all the assumptions. So all the money received by the public, 10% should be retained there, and the other portion should be go as deposit. From the deposits, 10% and 2% should be kept as cash and statutory reserves. Rest of the remaining can be loaned out. So the Bank B also do the same, right? Now we are going to summarize these steps using a summary table. These rounds and the deposits, notes and coins held by banks, central bank reserves, currency held by public, and finally the money supply we are going to calculate. Before that, coming to the definitions of the money supply, we have different definitions on money supply. One is M1, that is the narrow money supply. So this M1 base we calculated by adding currency held by public with demand deposits held by public in the commercial banks. So the currency with public plus the deposits of public held in commercial banks constitutes the narrow money supply, which is M1. So in advance we have M2, we call it broad money supply. That is M1 is the narrow money supply, M2 is the broad money supply. So to calculate the M2, for M1 we add time and savings deposits held by public. So additionally we do have M2B, which is consolidated monetary survey, and M4 we call it financial survey. So it's your homework to find the calculation methods of M2B and M4. How the consolidated monetary survey and financial survey is calculated, it's up to you to find out. It's there in the central bank in annual reports, and also if you Google, you can find it, right? So for now, let's say we want to calculate the M1 money base, that is the currency held by public plus the deposits held by public at the commercial banks, right? So that is money supply here, M1. So the round 1, first one, base money 10,000 was given to a particular person. So this 10,000 is with the public. So the currency held by public is 10,000. No deposits, no notes or coins held by banks, no central bank reserves at the first step, right? So then the money supply should be equal to currency held by public plus the deposits. But at that stage, no deposits. So the money supply equals to the currency held by public, which is 10,000. Then second step, that person who received the 10,000 will deposit in bank A. So out of 10,000, only 90% can be deposited, 10% should be kept as money. Then 10% means 1,000. Now the currency held by public will be 1,000 only. The rest of the 9,000 will go as the deposit. Out of the 9,000, 180 are the notes and coins held by banks, and 900 is the central bank reserves. Then what will be the money supply at the point 2? Again 10,000. 9,000 deposit plus the currency held by public, which is 1,000. Only 10,000. No difference so far. Now we come to the third step. Alright. In third step, this bank A, out of the remaining deposits after deducting the 180 and 900, which are the notes and coins they should help, and the central bank reserves, the remaining 7,920 they will issue as loans, right, by bank A. Then what will happen? No change in the deposits, 9,000. No change in the notes and coins held by banks, still 180. Central bank reserves also 900, no change. But that loan issued amount of 7,920 will go to the system as the currency held by public, right? Now the one person has received the loan. So that loan is with that person, that is currency held by public. So that 7,920 will be added to the currency held by public. So before we had 1,000 rupees here, and now this loan is also added as the currency. Then altogether we have 8,920. Now what is the money supply here? Now money supply M1 means deposit plus the currency held by public. So 9,000 plus 8,920, we get 17,920, right? Now you can see 17,920. Now you can see from the initial base money 10,000, the money increase up to 17,920, right? Additional 7,920 has been created so far. So the step 4, this the additional money here will be deposited in bank B. So the out of the additional 7,920, again 10% will keep as the currency. So from 7,920, 10% means 792. So the 792 will be added to the currency held by public, but that 1,000 was there from the beginning. So 1,000 plus 792, we receive 1,792 now currency held by the public. But the remaining 7,128 will be added to the deposit. So the 9,000 plus 7,128 equals to, now deposits are 16,120. And the notes and the central bank reserves, notes and coins held by banks also increase with the bank B notes and coins and the reserves, right? You can calculate how the 322 and 1,612 came. That is very easy calculation. So here again the money supply equals deposit plus the currency held by public, similar to 17,920. Why there is no change from 3 to 4? Because the money which was there by as the currency held by public was decreased from there and has added as deposit. So that's the difference. So no addition there. So anyway, from these few steps we can see the initial base money 10,000 has been increased up to 17,920. So that's the money creation. So I suppose now you are okay with the money creation process. Now money supply, I described already. You have to find M2B and M4 calculations, okay? Now we say this created money can be seen as implicit money. What is implicit money? Not actual money, but implicit money. That means this money are they are as electronic means and accounts, right? Because actually only 10,000 was given to the system as actual money, as issued money, right? Printed money is only 10,000, but it was increased up to 17,000 somewhat, right? So this additional money is not actual money, but implicit money. Why this happened? The reason for money creation is what? Because the transactions happen using other means like checks, debit cards, credit cards, likewise, not using money at all. If we use 100% cash for the transaction, we cannot create money. Why? Initially 10,000 was issued. If the 10,000 was used as a payment in cash and again as a payment to another source, then all that 10,000 was transferring from one party to another party. No money creation. But here, since this electronic means like checks, debit cards, credit cards, they are not using actual money, they just uh, use implicit money, right? So because of that, this money creation happened, right? If we use a debit card or a credit card, if we use a debit card and make a payment at the supermarket, we are not actually paying the money, right? Only a amount worth of money. Let's suppose I purchase goods amounted 300 rupees, so 3,000 rupees. Now I purchase goods from a supermarket amounting 3,000 rupees. Now I pay that using a debit card. Now actually am I paying? No, I'm just electronically paying that. So this 3,000 rupee worth of money will be debited to that supermarket account electronically, right? Not that the bank actually take 3,000 worth of cash, bank notes, and put it into a box named by the supermarket. No, not that happen. Just electronically they do debits and credit. Because of this electronic means, this money creation happened, right? Since that my payment 3,000 was done as an electronic method, maybe the actual money can be circulated from one end to another and then created some additional money, right? So the reason is the transactions happen using other means like checks, debit cards, credit cards, etc. So what is the time duration of a money creation process? Actually, it depends. It depends on the speed of the circulation of money. So if a particular economy is highly advanced technologies, there the people use electronic money, debit cards, credit cards. There are so many electronic ways of transactions, and the amount of transaction happening in the economy is higher, then the time duration of the money creation will be also accelerated. So it depends on the speed of the circulation of money. And also there are some misinterpretation of money creation process. One misinterpretation is the money creation is occurred only from demand deposit. No, any money creation can happen from any account or any type of loans, housing, business, credit card, anything, right? Not only the demand deposit. We say from the deposits only we can create money. No, can be any type, any account, right? And another misinterpretation is the money creation because of double entry system. Yes, double entry system provides it is a necessary condition for the money creation, but not because of the double entry system. Another reasons are there for the money creation, not only the double entry system. So this money creation process comes under the money issuance function of the central bank. So why then this money creation process and the money or issuance of money is critical. Why central bank consider it as a key function? Because this money creation is greatly related with the economic activities. They can greatly influence the economic variables like inflation, hyperinflation, recession, deflation, right? So money was greatly associated with economic terms. If we take inflation, suppose there are too much money available in the economy, then what will happen? If the firms can borrow more money, then they will buy more and more materials and new factories. They will hire employees, right? So they will expand the production. If there are more money in the economy, means too much money available at a lower cost. At that time the interest rates are lower, right? So the people can borrow money as much as they wish because of the too much money available for the commercial banks. So if that's the situation, so the production will be expand, right? And also the people will have more money to demand the products. So the aggregate demand will be accelerated. So when there is a higher aggregate demand, then what will happen? Then the prices will go up. That is the inflation. Inflation means the increase in the general price level of the economy. So that is the inflation. So if the people have more money, they will demand more, then the prices will go up, right? So the money creation and the inflation is closely associated. Then hyperinflation, the adverse situation of inflation. So if we have the higher volatility in the prices, we say hyperinflation. Not just a rise in price. If time to time, minute to minute, the prices are changing. So normally the inflation rate is double digit when we have hyperinflation. So when we have hyperinflation, the value of money is eroded greatly. So the hyperinflation is also not good for an economy, right? So then when we have hyperinflation, money is not a good store of value. People do not tend to keep money because the value of the money is greatly eroded during the hyperinflation. So during this inflation and hyperinflation, people cannot take optimal decision, consumption or investment because the prices are varies, uncertainty is there, right? So therefore, the money flow or the amount of the money in the economy has a wide impact on inflation and on hyperinflation. Also the recession. So what is a recession? If there's a continuous decline in the production, we call it recession. Continuous decline of a GDP over a longer period of time, then we say it's a recession. Then how the money is linked with the recession. So suppose that there is too much little money available on the economy. So there are very monetary constraints on the economy. No much money available in the economy. So there is a scarcity of money in the economy. Then what happened? So the commercial banks will charge a higher interest rate to lend the money, right? Because the money is scarce now. During a money is scarce now because of the tightened monetary condition in the economy. Then what will happen when the commercial banks charge higher interest rate? Can the people borrow more and more? No, they will refrain from borrowing because the borrowings are now much more costlier for them. So then the production will be contracted. These production firms will close down because they cannot go for investment. They cannot borrow money from banks because of the high interest rate. Then what will happen? Unemployment will be there. So this ultimately it will create a recession, the decline in the production. Then what is a deflation? That is the opposition of the inflation. Continuous decline in the price level. If the recession is worse, then what will happen? It will create a deflationary situation because of the unemployment and all this little money available in the economy. People will reduce their aggregate demand. So to attract the people to buy the goods and services, producers have to decline the prices because now the people do not have money to buy the products. Then producers will decline the prices until the products are attractive to the people, right? Because they do not have money during the recession. So recession, deflation, inflation, hyperinflation. So all are these economic concepts. So this money creation is closely related that it can influence these variables. So that's why it is critical for us to, not for us, actually for central bank to control the supply of money, right? So that's why the next task of the central bank comes as a key function, monetary policy as a regulator. So first task, it's all about the issuance of money, how the money is created, so how this created money can affect the economic variable. Not only money issuance, after the money issuance, since it has major impact on the economic activities, central bank has to control the flow and the amount of money in the economy, right? That is the conduct of monetary policy or the regulator of the money, right? That is the second task or second function, monetary policy as a regulator. All right. So we say that central bank is responsible for the conduct of monetary policy. That means simply regulating the flow and the amount of money in the economy. So simply it means they have to make sure that there is just the right amount of money available at the right cost to household and firms. Simply, right amount of money available means the money supply. At the right cost means the interest rate. So this conducting monetary policy or the regulatory function of the central bank means they have to ensure the right amount of money supply is available at the right interest rate. So they have to control the money supply and the interest rate as the regulator of the money. So how do they control this money supply and the interest rate? So the third point, money supply versus reserve requirement versus policy interest rate. So what that means? So normally, central bank no longer attempts to set a target for money supply. Why? Even though they want to control the money supply, they no longer set the targets for money supply because now they observe that the relationship between the base money and the money supply is unstable because of some of the financial innovations and the consumption and investment patterns of the households and firms, and some new financial innovations, like I said, debit cards, electronic payments. Because of that, the relationship between money, the base money, and the final money supply is unstable. It is really difficult to define that. So then talking about the reserve requirements, because of that, money supply was not controlled directly. Indirect control was there. And secondly, the reserve requirement, that means the ratio of the reserve that the commercial bank have to maintain with them, it is also something that cannot be changed frequently. Why? Why the central bank cannot change it frequently, even though that is the case? If you consider the latest practices by the central bank of Sri Lanka, especially during this COVID-19 pandemic, we observe that central bank frequently reducing the SRR, right? Statutory reserve requirement. Now it's around 2%. So that's a separate story. That is unconventional method, right? So based on the situation, that might be changed. But in the normal scenario, change in the reserve requirement to control the money is not advisable. It is not suitable to change it frequently. Why? Suppose that the central bank decide to increase the statutory reserves. Now they increase the statutory reserve ratio. It was there 2% before. Now they observe that too much money was there in the economy. Now suddenly what the central bank do to control the flow of the money, they increase the SRR up to 10%. Then can the commercial bank suddenly adjust to that requirement? No, right? They do not have that much of reserves available because after the reserve requirement, the remaining portion they will be lended out as loans. So when suddenly the government increased the reserve requirement, what happened? Then the commercial bank has to sometimes call in their loans back, right? To adjust with this higher reserve requirement. So the call in loan suddenly, it is very costlier for the economy. Suppose that the person has taken the loan for a 5-year period of time, but suddenly the bank asks them to pay back all the money within 2 years because of the higher reserve requirements. Is that practical? No, that is not practical, right? So the reserve requirement was also not recommended ad- as a wise method to regulate the money. Then later come the policy interest rate. So that is the instrument that central bank use normally to control the money. So as the regulator of money, if we compare the money supply, reserve requirement and the policy interest rate is the most ideal tool to use to control the money. And also apart from that, they can use financial market operations or open market operations, we say OMOs, right? So the policy interest rate and open market operations can be used to regulate the monetary conditions in the economy. Now let's say how the policy interest rate or open market operations are used by the central bank. First tell me, what is this policy interest rate? So the policy interest rate is the short-term interest rate that a central bank chooses to directly influence. Or the central bank use the policy interest rate to signal the public on the future economic conditions or the future price level. So this policy interest rate announcements have major impact on the consumption and investment decisions. When the central bank announced that there is a policy interest rate hike or cut, accordingly the decisions will be changed. It signals on the potential conditions in the future, potential price levels in the future. So how the central bank can signal? Using the policy interest rate. Suppose that central bank decides to increase the policy interest rate, but that signals to the general public. Always increase in policy interest rate signals that they have to tone down the acceleration of the economic activities. We have to slow down the economic activities in order to tame the rise in the general price levels. When the central bank increase the policy interest rate, in other words, it implies that there is a potential threat of inflation. You should have to slow down the economic activities conducted by you, right? So that is the signal. So on the other hand, if the central bank decrease the interest rate, what happens? So that might signals you central bank want to economic activities to pick up and also to rise in the general price levels, right? Why? Maybe that time central bank observes that the economy is somewhat stagnated, so the economy should be accelerated. There should be a boost in the economic activities. So in that situation, interest rates are declined. So these days also, continuously central bank reduce the policy interest rate. So that means they signal because of the COVID-19 pandemic, now our economy is somewhat stagnated and we have slowed down the economic activities. By reducing the policy interest rate, central bank signals the public you have to accelerate your economic activities, you have to consume more, you have to invest more, right? So if the central bank decides to keep the interest rate at that level, that means this money conditions in the economy are appropriate for the favorable outlook of economic activity. That means if the central bank maintains the policy interest rate stable without much no increase or no decrease, that means that money conditions are appropriate for the economic activities, right? So always these policy interest rate announcements we can use as signals on the future directions of the central bank and potential inflation or deflation. Right. So let's discuss how the policy interest rate or the open market operations are used by the central bank depending on the situation. First situation is when there is too much money available in the system. That means too much money there at a lower cost. So there are too much money available in the system. If that's the case, if there is too much money in the economy, there is a potential threat, right? Potential threat of inflation. So the central bank wants to absorb the money back. For that, they can increase the interest rate, increase the policy interest rate. So when they increase the policy interest rate, what happens? When the policy interest rate is increased, opportunity cost of the money is increased, right? So then always this information, this central bank announcements, all these informations are real-time information. Speedily they pass from central bank to the general public, to the firms and the households, right? So these news and informations are available on a real-time basis. So once the central bank announces the hike in the policy interest rate, lenders also adjust their lending behavior right away by raising their cost of the loans. When the central bank increase the policy interest rate, bank will also increase their interest rate. So when higher the interest rate, it is too much costlier for us to apply for loan, right? So the people will avoid from taking more and more loans. Thereby, the, there will be no too much money issued by the commercial banks to the system because of the higher interest rate. So this policy announcement, policy interest rate decision can be backed with the open market operations as well. If the central banks want to absorb the additional money back from the system to their hand, they will go for a government security bond purchase or selling, buying or selling. They will sell the government bonds, right? When they sell the government bonds, commercial bank will purchase them from the central bank. For that, they have to give the money for the central bank. So the money, additional money, the too much money which was there in the system will be drained out by the system, by the central bank to sell in the government bonds. So the money that buyers of bonds pay to the central bank will effectively be out of the circulation, right? So when there is too much money available in the system, we can do either interest rate increase in the policy interest rate, and we can back the decision with the selling of government bonds through the open market operations. So on the other hand, when there is too little money available in the economy, that means very little money available in the system with a higher cost, at a very higher cost. If that's the situation, central bank observe that they want to inject the money into the system. To inject the money, what they might do, they will decrease the or reduce the policy interest rate. So when they reduce the policy interest rate, opportunity cost of the money will be reduced, right? And then also the cost of the borrowing also reduced. As I said before, all these informations are real-time information. When the central bank announces we are going to decrease the policy interest rate, lenders also follow the same. Banks also will follow the cut of their interest rate. So when the interest rates are reduced, people will buy, people will take more and more loans, and they will purchase, they will consume and invest more. Thereby the money will be injected to the economy, right? And also this policy interest rate cut can be associated with the open market operation as well. It can support. How? By purchasing the government bonds. When the central bank purchase the bonds from the commercial banks, then they will pay back the money to the commercial banks. Then the money will go from the central bank to the commercial bank. So that thereby they will inject the money into the system, right? So effectively they're injecting money into the system. So that's how the central bank control the money supply. Monetary policy as a regulator means regulating the money supply and the cost. So effectively they use the policy interest rate and the open market operations to do so. So now so far we discussed two central bank functions. Uh, Money issuance, under that we discussed how the money can be created. Second one, conduct of monetary policy, or how the money is controlled or regulated, right? So using the policy interest rate and open market operations, we discuss how the central bank do that. Now we come to the third function, role of central banks in payment system oversight and provision. A new function, we haven't discussed it before. Payment system oversight and provision. Another major function, it is carried by the central bank. Now tell me before explaining the function, what is a payment system? We say a payment system have participants from individuals to banks, maybe governments, maybe international participants. They exchange the monetary value within the economy and across national borders. So that is the payment system. It has the payment system is all about how the participants from individuals to banks, governments, international participants exchange the monetary value within the economy and across the borders. So that is the payment system. So it has this framework of laws, regulations, mechanisms, systems, procedures, agreements that governs all these payment related things, right? It is a framework, payment system. Now the central bank. Normally the commercial banks often held accounts at the central bank. Why? From the history, if you observe, commercial banks keep accounts with the central bank. That's how the central bank can perform the payment system, since the commercial banks do have accounts with the central banks. So why the commercial banks keep accounts with the central bank? Because commercial banks consider central bank as a public institution, not a competitor, right? Central bank started to take the role as a public institution rather than a profit-making entity. So, central bank is less commercial. So, will the commercial banks are willing to keep their accounts with one of their competitors? No, right? They would not hold accounts with their competitors, who are the other commercial banks in the same line of business. So since the central bank is a public institution with less commercial purposes, commercial banks can keep the accounts with the central bank because they do not perceive the central bank as a competitor. And another reason why the commercial banks keep accounts with the central bank is central bank has a close relationship, close ties with the sovereign, right? So the commercial banks know that the central bank is safe and more reliable. Therefore, these commercial banks might keep their accounts with the central bank because they consider central bank as a public institution, not a competitor, and also because of the close ties with the government, they know central bank is safe and reliable, right? That's how the central bank was recognized as the bank of the banks, and they take the deposits and clear the funds for the commercial banks, right? So, but at present, instead of simply clearing the funds for commercial banks, now the central bank takes on a more active role in the national payment system. So in the national payment system, basically using two ways central bank interfere. In the payment system oversight and provisions function, we can say the central bank interfere there using particularly two roles. First one is as the regulator that ensures smooth functioning of the country's payment system, and secondly, as the service provider of the national payment system. So central bank has two roles under this function, regulator and a service provider. Now we will discuss what is this payment system oversight and what is this payment system provision. Alright. Payment system oversight. There basically what happens, central bank sets the rules and the guidelines regarding the payment system with the aim of these three. So under the payment system oversight, central banks set the rules and guidelines to achieve these three conditions. First one is to reduce the probability of a payment system's failure. Second one, improve the efficiency in the payment system. Third one, ensure the fairness and equity in the use of payment system. Let's discuss one by one. The first one, reduce the probability of a payment system failure. So what happens if the payment system fails? If the payment system fails, what will happen? So it will cause adverse effect on the financial system and also to the economy, right? Because participants of the payment system rely on the payments to meet their own liquidity obligations, right? So in extreme cases, this liquidity shortage can be resulted when the payment system is failed. For an example, let's suppose that when there's a power cut in your home, what happens? All your functions, all your tasks are on hold, right? If you do not have a generator or secondary power source, then what will happen? You cannot cook, you cannot watch television, right? You cannot activate your Wi-Fi, right? Likewise, all your activities will be disrupted during the power failure. Similarly, if the payment system failure happens here, it's like a power cut in the power failure in the financial system, right? So if that happens, all these payments will be disrupted. It might cause a liquidity shortage. When there is a liquidity shortage, it will lead to sometime financial panic or a bank run, right? If the payment system collapses, what will happen to the payments? The bank will be facing liquidity crunch. They cannot meet their obligations because now the payment system is not functioning smoothly. So the bank will go out of the funds. There will be a bank panic, bank run, financial panic, right? So it is very crucial for us to have a smoothly functioning payment system without system failures, because it will create this disrupt in the economic activities, and also ultimately it will create the financial instability. When there is regular system failures in the payment system, what will happen to the confidence of the participants? They cannot rely on the payment system, right? So the trust and the confidence of the people will collapse. Thereby, it will ultimately create a huge repercussion in the economy. It will create ripple effects throughout the economy when the payment system collapses. So that's why it is very critical to control to reduce the probability of the payment system failure. Then the second one, improve the efficiency in the payment system. So how we can improve the efficiency? What is the meant by the efficiency? So especially the new technology. When there is new technology, we can improve the efficiency, right? But however, this private sector might not have the incentive to move to the newer technology. So because often this new technology requires major investment. So there should be someone else to do this. That is the public sector, particularly the central bank, right? So the central bank can issue the guidelines and regulations to help coordinate the players in the private sector to move to the new technology on an appropriate timeline, right? So what does that mean? So when there is a new technological advancement in the system, if there is nobody to regulate it and to provide guidelines, private individual parties in the payment system like private commercial banks, they do not have incentives to go for this investment because they are major investment. But if there is one particular government body to regulate and to provide guidelines and to instruct them to follow these new technological changes, then they will obey the commands, right? So to improve the efficiency in the payment system, central bank should be there to do the technological advancement, right? If the payment system is efficient, then the central bank can inject and absorb the liquidity more quickly. And also the other commercial banks also can efficiently manage their reserves. They can borrow and lend more quickly as needed, right? When the payment system is efficient, right? If the payment system is not efficient, if it is time consuming, and if it is engaged with so many manual settings, then the efficiency will be decreased, right? It will take more time for the settlements. But if the system is efficient, all these monetary operations can be conducted in a quick time period of time. Efficiency means that, right? So that's why the central bank involved in the designing and the regulating the payment system. And finally, the third reason, ensure the fairness and equity in the use of payment system. What is that? So normally this payment system has been considered as a public good with positive externality. Public good with positive externality. What is meant by that? Public good. I'm not going to explain you the public good or the positive externalities. Those are there when you are doing all these microeconomics and macroeconomics, right? But why the payment system has been a public good? Because of the higher investment and the less incentives by the private sector, government has to uh, provide the payment system facilitation. So that's why it is somewhat sort of obligation of the government or the central bank. So we say this is a public good, but with positive externalities. Even though this payment system controls by the central bank, all the positive benefits can be taken by the whoever the party engaged in the transaction in the system, right? Can be commercial banks, can be other non-financial institutions, can be individuals, can be foreign institutions, can be anyone who engage in the transactions. They can take the benefit. That's why we say it's a positive externality. So we have to make sure the fairness and equity. Why? Let's suppose that the private sector is the one who's facilitating the payment system. Then will the private sector will allow other small players to access this network? No, right? They will not like to have free riders. Since they have invest, they will only use the benefits for themselves. So to ensure the fairness and equity and affordable prices for the services, central bank should be intervening and regulating. So that is the meaning of the payment system oversight. So simply payment systems oversights mean they have to central bank interfere to reduce the system failures and to improve the efficiency and also to ensure the fairness and the equity. Then the next part is the payment system provision. So this payment system provision means this payment settlement system is a single integrated central system. So why? Because if this system is different fragmented system, can the other people or the commercial banks rely on this? No, right? Since this is a single integrated central system controlled by the central bank, then the other parties who involved with the transaction can rely on this because this is a single integrated system. And the service provider, they can, as a service provider, central bank accommodate the payment settlements as wholesale payments and also in small value like check clearing and all. So that is the whole picture about the payment system oversight and provision. So simply what you have to know is what is payment system oversight and the provision, how the central bank interfere to do this function, right? So the last function is the role of central bank as the lender of last resort and the bank supervisor. So this lender of last resort function, I'm not going to explain much more because we already explained what is meant by the lender of last resort, right? So that is the last option that the commercial bank have in a collapse or in a bank run, in a financial panic, right? But this is a very controversial function because most of the time, because of this moral hazard problem, we discuss what is moral hazard problem also. What is moral hazard problem? That means since the commercial banks know that the central bank is there in case they fail to help them out, they will engage with riskier activities in expecting high returns, right? To expect high returns, to earn high returns, they will engage in riskier activities. Knowingly, in case they fail, central bank will help them out. So that problem is there. Because of that, the central bank is so much unwilling to perform this lender of last resort function. But during pandemic situation like global financial crisis and during all these catastrophic situations, central bank has to do this function to help the troubled financial institutions. So there can be several forms that the lender of last resort function can be taken place. There are especially three forms. The first one is liquidity to individual banks. That means what? Liquidity to individual banks mean the central bank provides short-term loans most of the time against a collateral such as government securities likewise. So this case, the problem is not that much severe. If the central bank helps the bank to meet the short-term obligation, thereby they can come to the normalized operations. That means it is only liquidity problem, not the solvency problem. So you should be having a clear understanding between liquidity problem and the solvency problem. So if the short term obligations are met, if that particular bank can come to the normal operation, that means they have the liquidity problem. So as the lender of last resort, they might give the liquidity short term loans against a collateral to the banks to help this liquidity problem. That is one form that this lender of last resort function was carried out. The second form is the liquidity to the market. So especially in situation like the Great Depression, global financial panic, all the system has a liquidity problem, not a particular bank or a financial institution. The whole system has the liquidity problem. At that time, central bank will inject money into the system, not to a particular bank, but to a system as a whole. Then the third form is injecting the risk capital into a troubled bank. So that means there is a severe problem there, not only a liquidity problem, there can be a solvency problem in that particular troubled bank. So if that particular bank is unable to return to the normal functioning, even after meeting the short-term obligations, we say there's a solvency problem. In that case, the bank would interfere by injecting the risk capital, and they might take the ownership of that particular bank to their hand, right? So there are three forms. Liquidity to individual banks, that is for the short-term obligation, not solvency problem, but liquidity problem. Second one, liquidity to the market. So in a situation where all the market collapse, like global financial crisis, Great Depression, so they inject money into the system. Third one is to the troubled banks. When they have solvency problems, they might inject the risk capital. So that is all about the lender of last resort function. There you have to know about the moral hazard problem and how the central bank can reduce this moral hazard problem, right? So the last part, bank supervision. So here the bank supervision means the central bank's formal duty to inspect the soundness and the soundness of the commercial bank's operations. So they issue regulations that will ensure the soundness of the commercial banks, right? So here, in practice, the modern central banks have a number of related supervisory functions. So among them, the main functions we can identify are the licensing of new banks, examination and monitoring of banks' operations, setting regulatory requirements for banks, enforcement of regulations to ensure corrective actions, providing resolution for troubled financial institutions when necessary. So all belong under the bank supervisory function. So here you can refer your reference book as well. There in detail they have explained all these sub functions, but I'm not going to explain one by one. But in a nutshell, this licensing of new banks mean central bank is the party who can give the license for the operation of a new bank, right? For that, the bank will observe the business plan of that particular bank, the board of directors, whether they are fit and proper, likewise, all things they will study plethora of things before giving the license, right? And the second one, examination and monitoring of banks operations. So there can be on-site examinations, off-site examinations. So it is up to you to find what is the difference between on-site examination and off-site examination, right? In on-site examination, central bank send a team to the bank and observe and check all the procedures, guidelines, everything. In off-site examination, central bank will use the information collected throughout the on-site examinations and the other secondary data, and they will observe whether this particular bank is meeting the regulatory requirements imposed by the central bank, right? So they can enforce the corrective actions, and also they can provide the resolution for the troubled financial institutions. So what are the resolution that they can give for the troubled financial institutions? So they can go for liquidation, OS nationalization, extremenment, purchase and assumption, conservatorship. All these things are in your reference book. Better you have a look on all these bank supervisory functions. So there are two discussion questions I have given to you. Better you do it yourselves. The first one, do central bank need to supervise banks or not? Actually, in our previous sessions, I gave you a group activity, giving you a case study on your reference book. There also we examine whether central bank has to do the supervision or not. So this is again related to the same context. And finally, what exactly is a modern central bank after all, right? So now, tell me, so far we discussed, what are the things that we discussed so far? We discussed the roles and functions of modern central bank. So there we understand that the central bank has to maintain the monetary stability and financial stability. To achieve these roles, these primary functions, these key functions will be carried out by central bank. So this is all about modern central bank, right? So all these functions will be carried under the modern central banking in order to achieve the monetary stability and the financial stability. So that's all from the session 5. I think you better have a self-study on the reference material to get additional information. Thank you very much.